We've got some fresh new young talent doing some things that I know you haven't heard before.
1, 2, 3, listen.
Welcome to Finances, your home for all things financial, investment, money and lifestyle. Hosted and curated by the very talented team of certified financial planners, Burke Britton Financial Partners. This is another episode of the Finances podcast. Guest today is Will McKenzie from Achieve Home Loans. Will, thanks for coming on, mate. This is your first podcast ever.
It is, so thanks for inviting me. And I've got a good head for radio, so
well,
that's why we're all got the camera on
as well. Ben's here as well. So Ben,
g'day guys.
Good to see you here today, Ben. Back for your third.
Right into the thick of it now. So
we always probably start. I know we did a little Zoom. I don't know, probably 12 months ago, where Selena and yourself gave a little bit of background of your business. Let's keep it tight, so we'll jump on to the more topical areas of lending and finance, but a little background on yourself, Achieve Home Loans, and I suppose how long we've been or had a relationship with you and your business. Mm-hmm. Over to you.
We started Achieve Home Loans in the year 2000, so we've been around now in Geelong for 20-odd years, and I come out of the finance industry and saw a niche, if you like, within the market in Geelong, and that's what set us off. We started very, very small and grew fairly rapidly, and we've still got lots and lots of clients that we saw back in those early years. In fact, these days we do loans for the children of the clients that we were looking after 20 years ago. So that tells me that we must have been doing something right over the time, because people keep coming back, which is great. The finance industry is no different to the rest of the economy. It has its ups and downs and things in a constant state of change. And we've just been through, as people would know, a property market cycle where it's been on the up and up and up. There are three areas in the property market that happen. It's either going up, going down, or it's stagnant. And at the moment, it's on the way back down as interest rates rise. So it's a very interesting time for all concerned. Some people are not used to seeing interest rates increase. In fact, in the last 10 years, I suppose, there's a whole generation that have never seen this happen. I go back to my early days when we were paying 17.5% for our home loan. Hopefully it won't get to that again anywhere near future, but interesting times indeed.
Yeah, we had a podcast the other day where we were talking about a generation of people that hadn't seen market conditions, so the equity market, the share market, with the two successive, fairly significant downturns in the start of 2020 and then the start of 2022. Interesting that you've got a whole swath of the population that really haven't seen lean times, if you like. So,
and they think that rates, like they look at rates now and think, how high are these interest rates, when you probably look at them thinking, not too bad. Historically low.
What did you say the peak was in your time?
The cash rate got to 17.5%. Mm-hmm. That's the cash rate. And these were in the days, and I'm loath to mention the word pyramid when I'm in Geelong, but, those were the days. And that's the sort of rates that people were paying. Granted, the loan numbers in those days were quite small compared to what they are today, perhaps, but so were the salaries. So everything's relative, and somehow people made ends meet and still bought properties and sold them and paid them off, etc.
This is probably a question without notice. Can you remember what the sort of proportion of household income to property value was back then?
I can only relate it back to our situation. In our first home, I think the house cost $27,000, and we put it on a block of land that we paid probably $7,000 for. Again, the rates were about 17%, and I'm tipping that our weekly income was around $300 a week.
Okay.
So,
how old are you?
So
this is just pre-Great Depression.
It's not that long ago. I was reading something only just in the last couple of days, and it was about the property market, and this was data from CoreLogic, who should know what they're talking about, and they were saying that the property, since early 90s, property has risen an average of 5.4% per year, compounding. That equated to, and I did those numbers on that little house of ours that cost us 30-something grand when we built it. In today's values, that comes out at around about $300,000, and that seems to correlate with what the market is. This was down in Warrnambool, just a normal little residential place down in Warrnambool, so I doubt that you could buy a house down there these days for under 300 grand. But that's, and I think over time that percentage increased 350% or something over those number of years from then to now. And, we sit here today and we see property prices at $1 million or whatever they are, and we think, gee, it's never going to get too much more than that. But it does, and we're talking telephone numbers, but everything else increases at the same rate.
You mentioned before we started recording that when rates are low, you're doing a lot of work for clients looking to purchase properties, and when rates are high, you're just as busy, but you're busy refinancing existing loans. Maybe if we jump into that, because I know it's quite topical at the moment, about the impact of rising rates and what sort of stresses or what sort of opportunities it's presenting to people out there. From your perspective, what are you seeing as rates are rising? Obviously, you're getting many more clients wanting to refinance, but what are the other aspects of a rising rate environment that are impacting consumers, clients, people with property?
The biggest impact that it has for our customers is their borrowing capacity. And since, what have we had, 7 rate rises in a row every month? And again, I saw a study the other day where people's borrowing capacity is diminished by something of the order of 25% in that time.
Do you want to just explain that? I know, obviously, you will send through and copy through to us some of the serviceability calculations that you do for clients, but maybe for those people who don't know or don't understand why a rise in interest rates means that they can actually borrow less. In layman's terms, how does that come about?
I'll try and put it to you in the simplest form I can. When a lender looks at someone's borrowing capacity, they look at the total income coming into the household. They then take off that whatever normal living expenses are for that family, whether it be a couple or a couple with children, etc.
Can I pause you just there on that living expenses?
Yes.
Maybe just a footnote there to touch on how that's changed over time, what the banks actually take as living expenses. Sorry to cut you off.
No, certainly. Once upon a time, we used to put in a figure that was normal for living, what we call normal for living expenses, if you like. In inverted commas. And the banks would accept that. Since the Royal Commission a couple of years ago, the banks got hauled over the coals for not looking hard enough at people's expenses, etc. And look, as a general comment, I would say that most people will underestimate their living expenses. They really do. And so...
Couldn't agree more.
Yeah.
Every time we speak to a client, it would be the same thing.
Yes. Yeah, when we do a household budget, there always tends to be a little black hole somewhere that makes their cost of living almost look like a work of fiction. You go, where is that 10, 20, 30,000 black hole? Because people underestimate significantly what it costs them to live.
Yeah, so what the banks now want us to do, and it's almost forensically examine people's living expenses. So we have to download their bank statements, their daily transaction statements, and go through them with a fine-tooth comb to see where the money's going. And then there is a measure called the HEM, which is what the banks use, Henderson Expenditure Measure, I think it's called. But the banks use that, if you like, as a starting point. And they have 3 figures, one for a low expenditure, one for moderate, and one for high as a lifestyle. And so they then look at bank statements of the clients and see where they're spending their money, what they're spending their money on, and then they will go through that and then they'll add up what the true expenditures are. So when the banks are looking to determine what your borrowing capacity is, they will look at, as I said, what your income is coming in, then what you're spending on living expenses. They'll also then take into account any other credit commitments that you may have, what your credit card, your personal loan, your car loan, etc. They'll take all of those things into account and they'll then work out what's left over, if you like, out of your, call it spare income, that you would have available to spend on a home loan or a mortgage loan. They then take that figure and do a reverse equation to work out what they can lend you. And if your interest rates today are at 4.5%, they'll load that by a further 3% when they're working that figure out. So
that margin for increase, is it set at 3% across the board? Is that dictated by each individual bank, or is it mandated across the board?
It does vary from bank to bank, but the minimum loading that they use is mandated. So it used to be 2.5 basically across the board, and not that long ago the regulators said no, that's not enough, it has to be a little bit more, so they bumped it up. So long story short, what happens then as interest rates rise, that money you've got left over to spend on that mortgage, more of that's chewed up in interest, there's less that's going to be available to pay principal, so therefore they won't lend you as much. And so that has been the problem. We've had, just as an example, young people who've purchased land with a view to build in a couple of years' time. When they bought that land, they had capacity to build a new home for $500,000. Today, they only have the capacity to spend $400,000 on that new home. And of course, whilst their borrowing power has gone down, the price of building has gone up. So, unfortunately for some people, they find themselves in a situation where they can't do anything. They've just got to hold on until things turn around, which they will do eventually.
Or they sell that block of land, either or, but they're probably not going to have any luck. Their borrowing capacity doesn't change if they're trying to purchase a ready-made house either. So. No, indeed. And then there's cost to buy and there's cost to sell, which just adds to the equation.
So when you think about this, I know it's easy with the benefit of hindsight, but if you give people tips on how they could better prepare for being ready for either a refinance or purchasing a property, what are the key things that they actually need to take care of so that when they come to you or they come to us and we refer them on to you to do the serviceability on their loan, what can they do to be better prepared to make sure that they're more likely to be able to get the finance that they actually want and need?
Very, very good question, and it does vary from one person to the next. And when people do come to see us, we never say, sorry, you're a lost cause, go away, we don't want to talk to you. If we can't help you today, we will work with people and work out a plan to moving forward. So, righto, to get into a position where we might be able to do something, you need to do this, this and this. And those types of things might be, if we've got 2 or 3 small loans, we might consider doing one large personal loan to consolidate those debts. And quite often you can reduce your overall outgoings by rolling all those things into one.
So just, again, practically, what does that do in terms of improving the borrowing capacity by consolidating the debts?
Okay, well, go back to our borrowing capacity checklist where the banks look at whatever money is going out of the home into other accounts. If we can reduce those payments so there's not as much going to pay off the credit cards, there's more left over to borrow for the house. So by simply doing a debt consolidation, as long as we can reduce the payments, that's where it helps us in leaving more money left over to go towards the big one, which is the home loan. So that would be one step. Number 2 is savings. Again, depending on people's situations, sometimes people have good savings and lots of equity, so it's not an issue. However, if people are looking to borrow more than 80% of the value of the home, they get into an area where we have to pay, or they have to pay, what's called mortgage insurance. So that's an additional cost. It covers the banks should they default, but the clients have to pay it. And that is on a sliding scale. So the more you have to borrow as far as the percentage of the property goes, the higher that cost is. So, the more savings that you've got, that you can reduce that, that's going to help you in your overall costs.
I know this is a fairly broad question, and we won't hold you to it, but do you personally have a rule of thumb or an ideal level of savings? And we can let's use $1 million property. What ideally do you like to see people contribute towards a property? And I know there's many variables, and this is not advice. We'll put all those caveats there. But as an example, a hypothetical, someone comes to you and they want to buy $1 million property.
Yes.
Perfect world. What would you like to see them with in terms of their income, their savings?
Yep. Okay, so $1 million property, there's 3 areas that lenders look at. We call them the 3 C's. They look at C for creditworthiness. We assume that's going to be fine. They look at C for capacity. In other words, what can you pay? What's your borrowing capacity? And the third C is C for collateral. How much equity are you going to have in the property? So let's talk about collateral for a start off, equity. If we don't want to borrow more than 80%, so on a $1 million property, we want $200,000 plus the stamp duty, which would be another 60 in round figures. So to buy $1 million property in an ideal world, come to me with $260,000, a good job and good income that'll service the $800,000 loan that we want, and away we go.
How many people do you see walking in with that level of contribution, collateral to a property?
Not many.
Would that be what we'd consider a clean skin, someone that walks in?
Correct, yes. And that is very much not the norm.
So even how they've come about getting that, and I've seen this with clients where they might have that deposit, but they received it from inheritance, so their actual ability, they didn't create that themselves. Mm-hmm. So again, then when you dig into it a bit further, on the surface, looks pretty good, but how did they actually come to that?
So they might not necessarily have then the income
and that's
to service.
More jumping into that next stage of it, isn't it?
Yeah, well, you're right, and gets back, we talked earlier about living expenses, and people underestimate that. And if keep it simple, someone's netting $100,000 a year and they say our living expenses are 30, well, I say to him, well, where's the 70 grand a year that you haven't saved?
Yeah.
You know, what's happened to that money? So that's one part of it. And you're right, depending on where the deposit or the equity comes from. So, and that's where people need to come and talk to someone like ourselves, because we know all of the bank's rules and regulations. So we know what box you have to tick to fit into this particular bank or that bank or whatever. So we would like to think that when we put an application forward, that we know it's going to be approved. So we're not wasting your time or ours. So we do all that homework. As far as equity goes, it can be a gift. There's nothing wrong with that. But as long as it's disclosed, normally the banks like to see that money sitting in your bank account for 3 months. If it's been there for 3 months, they don't care where it comes from, to be frank. You know, I wouldn't suggest you go and put it on 25 red at Crown or something like that, but they really don't care.
Yep.
As long as the funds are there, they'll be more than happy. What we have been doing a lot of in the last probably 12 to 18 months is parental assisted loans. And so that might be where you want to see a client who's got some savings, because it demonstrates their ability to be frugal as far as their finances go, and you know that they're going to meet the repayments. But if they haven't got the full 20% and mum and dad are happy to help by either gifting some extra funds and or putting up an additional security, we can do loans there and negate the need for the mortgage insurance and still get away with that lower deposit, provided that the people can service the loan.
So I think historically, I used to call it a third-party guarantee. Am I right in saying that there was a period of time where that kind of went out of favour and there was only a handful of institutions that really did those third-party guarantees? Are we seeing those becoming more prevalent now? Like you're seeing as property prices go up and obviously mum and dad's value of their property that's unencumbered goes up, and the kids maybe are struggling to get together the income and the collateral that they need to fund a property. Are banks now starting to open up more around third-party guarantees, or has it not changed?
It hasn't changed in as much as they frown upon third-party guarantees unless the guarantor is receiving a benefit from purchasing the property. Now, most third-party guarantees, that's not the case.
So is my terminology third-party guarantee incorrect when you said a parental
guarantee?
Parental guarantee. Okay.
That's now the terminology for it.
Got it.
And there are two parts to that. One would be what's called a servicing guarantee. That's where income might be short to service the loan. There are only a very, very scarce number of lenders that will entertain that. They want to see that the main borrowers can service the loan off their own bat. The main one that we do with parental stuff these days is what they call the security guarantee. And that might be where, I'll try and give you a simple example. Say if people want to buy $1 million property and they've only got $100,000 cash themselves, so effectively that might be a 90% loan. So they would have to pay mortgage insurance. And on a loan of that magnitude, mortgage insurance for a 90% loan might be in the order of $30,000. It's not cheap. It's a lot of money.
That's a one-off expense that no one gets back.
Exactly. That's right. Yes.
Burn your 30 grand.
Yeah, and it's just gonski. But however, if you folks can put up a second property as security, that can be their own owner-occupied property or an investment property. It doesn't have to be a first mortgage. As long as they've got some equity there that the incoming bank can tap into, they'll take that equity, if you like, as additional security. So instead of borrowing 90% on your $1 million property, you are still, in dollar terms, borrowing 90%, but in security terms, you're not, because that additional property is there and you don't have to pay that mortgage insurance and you save that sort of money.
Do they break that again? I've seen some clients with similar. They break that down that security is only against that 100,000. It's not against the full 900. Is that something that's changed over time, or has it always been just that portion to bring it up to 20%?
Well, that's a very, very good point. What they will do, and I say to our clients, listen, if your parents are going to be good enough to put up their property to help you get into the market, we would hope, and history tells us that in time, your value of your property will go up, and then you make some inroads into your loans and pay them down. Eventually, you'll be in a position where you'll have sufficient equity in your own place to give mum and dad's title back to them free and clear. And for protection for the parents, yes, it is. It's a definitive number that they're guaranteeing. So they're not, a normal guarantor would sign up for the whole loan and be responsible for the whole loan. In these instances, it's split into two parts. So you've got loan 1, which is the 80% portion against the property, and then loan 2, which is the balance. And obviously that's the bit that's subject to the guarantee. And I say to my clients now, listen, if you've got any spare money as it comes along, you hook into that one. Try and pay that one down as quickly as you can. And in 12 months, 2 years' time, we'll revalue your property. If you've got the equity there, we can let mum and dad off the hook, and away you go. You paddle your own canoe from there.
I think it's a big comfort for the guarantor as well as the purchaser who's being assisted, because they know it's on that portion. Like, it's
Indeed.
when they can look at it, break it down, they're only guaranteeing that small portion. Well,
Yes.
it's still a significant amount of money, but it's not the entire amount. I think that's one of the big misconceptions with it that people have.
Well, look, that's a very, very strong point that I make. The last thing we want to do is tie people up for an infinite amount of funds, because life happens, situations change and things like that, and you just never know.
I suppose the link to that being, say that you use the parent's property as that leverage or the security, if they go to sell it and move, does that create issues where they've then got to rework as well, don't they? So they've got to be conscious that they've got it there now and they might move. Yep. It obviously changes where it's then tied to.
It will do, correct, yes. Yep.
So, and again, I think some people probably find that out all too late, which then causes hold-ups of settlements and all sorts.
Yes, yeah. And it's interesting, under current legislation, we have what's called a best interest duty, and we're legally bound to look after our clients and do things in their best interest. That also incorporates the guarantors. Yeah. And I'm a parent myself, and I've got 5 kids, and I know that to get them into the market today, and given the prices and things like that, this is going to be happening more and more and more. But you don't want to put yourself in jeopardy. You can cope with a finite amount, and then you can make a commercial decision as to whether you want to be involved or not.
Well, we probably see that from the outside, don't we? We have clients wanting to help their kids, but we've sort of got to have that, we've got to protect them from their kids in a sense where they want to help them to their own detriment at times, don't they?
Well, I think this is where, and we'd be remiss not to talk about it, that, the risks attached to these things. And that's why it's important to talk early and understand what you're actually getting into, so that you go in with your eyes wide open to a parental guarantee situation. Here's a question for you, Will, coming from a fellow father of 5. If every one of your kids wanted a parental guarantee from Dad, could you do that? Could you have 5 parental guarantee arrangements with each of your kids secured against one of your properties? Is that possible?
It is possible.
I'm just forward thinking about how the hell I'm going to get all my kids into.
The better way is to train them properly as to how to save in the first place, so they don't need to tap into mum and dad.
That's the correct answer.
But no, you're not limited to one necessarily. And like any parent, well, I would like to think any parent will treat all your children equally. So,
unless there's one you don't like.
Well,
I'm looking at Ben. I think Ben might be the black sheep of his family.
Right.
Yeah.
But no, like that can be done. But it depends too, I suppose. In our case, thankfully, their ages are spread apart a little bit, so it gives us some time to help one and then catch up before we have to help another.
You've obviously dealt with everything from the clean skins through to very complex scenarios. I'm assuming, and I kind of know the answer to this, but the burden of administration on home loans has become increasingly significant. How have you, as a business owner and as someone who wants to continue to deliver service, like you said, you don't turn people away, but the burden of actually completing assessments for people has increased ridiculously since the Royal Commission. How have you dealt with that, and how do you now look at clients moving forward and giving them the service that they obviously deserve, but also so that you can continue to deliver high standards?
Right, you're right. It's a service that they deserve, but it's also a service that they'll have to pay for as we move forward. The administrative burden is such that we now have to employ additional people just for that very purpose alone. And at the end of the day, we all go to work and we all like to get paid at the end of the week, and we're no different. So the amount of work that we have to put in to get to a file, get a file to the stage where we can actually submit it, is quite significant. Now, we would like to think if we've done our job properly, that file will always proceed, and that's great. And so we've earned our keep. And that's what we do. We charge a fee for service now. It's not huge, but it's something to help that administrative cost, and that will be increasingly the case in our industry as we go forward.
How have you found that has been received by clients up until now?
Clients are well within rights to say, well, listen, I could walk straight into the bank and get a loan from them, and I wouldn't have to pay them a fee. And that's correct. But if they do that, they're going to one place only, and they may or may not get good service there. I can guarantee you they'll be treated as a number, not a person. Whereas we treat our clients as part of our family, if you like, and we have a spread of 30 different lenders. And you'd like to know before you applied that you're going to get an answer for a yes. And the biggest part to that is knowing which lender to apply to. which niche that you fit, because they're all slightly different. And that's part of our job, and that's where we earn our keep. Number one is, if you like, painting the picture to the lender the way they want to see it and presenting the information to the lender so that they are comfortable to give you a quick and positive answer. And that's part of the process. How have people coped with that? When we explain to them the amount of work that we have to do and the benefits that we can give them in regard to making sure we're applying to the right lender for their particular situation, people haven't had any qualms with that. And I guess on top of that, again, we have, because of best interest duty, we have to make sure that we're putting the client to the lender that best suits their situation. There are some lenders about these days that will offer cashback to try and attract business, and that, without being too political about our industry, I don't think that's necessarily a good thing, but it is there. And so we say to people, listen, you might have to pay a fee for our service, but if it suits your situation to go to a lender where that cashback comes back, that will more than compensate for what you're paying us for the service.
You go, Ben.
No, that was off the back of that, I suppose, in terms of that process. And I was talking to Selena the other day about how you go about collection of data and trying to make that process easier. And she sent me through a link about a new program or something you're using to do that.
Yep.
Again, I haven't really had too much to do with it, but just thinking about that next phase. I know people think about when they've got to refinance, they've got to go through and get out all their statements and every single bank account and everything they've got. Is there a system that you guys are now using that's making that easier? Is that correct?
Yes, and you're right. To get together all the supporting documents that are required is quite onerous, and quite often that will put people off even wanting to do something. It's
we see that.
Too hard.
Had one recently, and I said, look, they've got a new system. Go and have a chat to them about it, because it will make it a lot easier.
Yeah. So in this digital world, as long as people can give us their account numbers and the authority, we can then go to the bank and download statements and get all the information direct from the bank straight to us. It's all secure. It's encrypted, done through the bank's system. So it's as secure as your information is with the bank. Once the stuff is downloaded to us, that link is then killed off, so we can't get in and spend all your money or anything like that. But we do get the information, and it's a lot easier for us because it's far more concise, and it's far easier for the clients.
Yeah.
And in days gone past, people would come in, they'd give me a couple of pay slips, we'd have a talk, and away we would go. It's not like that anymore. The banks want to know the ins and outs of absolutely everything, and I can understand why that's the case. But and I call it golden rules. They've got the gold, they make the rules, and we have to play by their rules.
Yeah.
And so if you want an application treated promptly and a quick answer, give us all the information we require up front. Because as soon as there's one piece missing, it goes back to the bottom of their pile again. And so we have to come back and get some information from you and wait for it to come back up the top of the pile, and then it goes again. If we have it all there in one hit, it can be approved in one pass, and that's easy for everybody.
Perfect. Again, any way to make it easier, I think is good for everyone.
Yes, yep. Yeah.
And also setting expectations for people. I think a lot of the time when people are upset or confused about why they need to provide so much information, it's about managing expectations. And as the industry's changed, I know our industry's changed significantly over time. And I know in the early days of us moving from more of a trail commission to a fee-for-service model, people were trying to wrap their heads around what they're actually paying for, the value that they received. I think the same applies for your industry now, that as you move to more professional service-oriented business, the need to charge a fee for service is warranted. And as long as, again, you charge a set fee for a defined level of service, I mean, most people are happy if they get what they're paying for. They're very happy.
Yeah, and I think if people query that, I would refer them to all the testimonials that we have, and they're all genuine, and people really sing our praises as to the level of service that we do give them, and we get the results. So, and that's at the end of the day, people don't mind paying for something as long as they're getting what they pay for.
100%. And even talking about before where they're a bit, it's all about confusion, or where they're uncertain of anything, is where people, they lose track of what they're actually doing, like why they're doing it. And then sometimes you just got to do that refresher and then bring them back into line with what you're doing. And I'm sure that you probably feel like you have the same conversations 5 times over with some people, but it's pretty foreign stuff to people. Like even, we're pretty close to it around the industry, but it's always changing. We're always, you got to learn and keep refreshing ourselves. So people that might only look at their mortgage and redo it every 5 years, they're almost starting from scratch again each 5 years.
Yes, yeah. That was brought home to me just this morning. We put an application into a lender, and they came back and said, the loan servicing calculator you used, that was produced in October. Rates have gone up. It's out of date. And that's been the case every month for the last 8 months. So it is hard to keep up with things at times. It really is. Yes.
Especially at the moment when we're in this moving period, which people will get spooked by.
Yeah.
It's more normal than it probably has been.
It's very, very interesting. When rates first started to creep up, we had lots and lots of people who were concerned about it, wanted to do something about it, and so on. Look at alternatives, etc. And you can look at alternatives, but quite often the cost of changing doesn't match up to what you're going to save. So sometimes you're better off just to stay where you are, approach your current lender and see if they'll do something for you as well, which we do on our clients' behalf all the time. So that's one thing to go about it. But I've lost my train of thought now. With the ever-changing situation, you can chop and change and things like that. And early days, when rates started to move, we used to get lots of inquiries. But as that's become the norm, for want of a better word, every month rates are going to go up. Over the last 3 or 4 months, people have been very, very quiet. They're resigned to the fact, well, look, rates are going up everywhere. If I'm with ABC Bank and XYZ Bank, it doesn't make any difference. They're all going up the same.
I think people forgot that they all go up.
Exactly.
People feel better when everyone's sharing the pain.
Yeah,
not just them.
Yeah, yes.
Definitely.
Yeah.
Talking about the huge changes in interest rates and also property, we won't hold you to this, Will, because I know I'm hitting you up with all the hard questions today. We know you're not a registered property agent. We know all of that.
Mm-hmm.
You've been around for long enough. I think we said you started your broking business back pre-World War II. But seriously, what's your view? Again, just your own personal opinion, not advice, on where you see rates going and also where you see property going. Now, I know that's very broad, many different areas of property, but give me your thoughts, your opinion on what you think is going to continue to happen in the property market and also with rates.
People ask me this all the time, and the first thing I say is, well, I don't know how good my crystal ball is, and you're right, it's not advice, but
Good disclaimer, I like that.
But from my many years of experience, I can tell you that my crystal ball is telling me that rates will continue to go up into early next year. I think they will plateau towards the end of the first quarter of next year. I think the heavy lifting has been done as far as the rate increases go from the RBA's point of view. I think they'll temper that, and I think that rates will shallow out, if you like, in the middle of next year, and toward the end of next year, it wouldn't surprise me at all to see them coming back down. The property market goes in the opposite direction to all of that. So as rates continue to go up, property market will continue to come down. Having said that, people tend to lose sight of the fact that it's come off record highs. And, the net increase to what your property was worth 2 years ago is still pretty good.
It fits in spurts with that market, isn't it? When it really runs, it properly goes.
Yeah.
And then it has this bit of a stagnant period, and it almost, when it's not going up, everyone feels like it's going down. And it's probably come off a little bit.
Yep.
But it's...
So, and it's as if you look at it, rates going up, market coming down, rates level off, market will level off, rates come down, market will start to come up again. That's my take on it, if you like, going forward. I'd have to say different areas, property market's still very, very strong. In some areas it's come off quite substantially, but that presents opportunities for astute investors. If someone's selling, there's always someone buying, and vice versa.
Talking about the rate rises, I know lots of people that, I suppose the noisy minority are always telling you about how they locked in very low fixed rates. Many people fortunately had done that during this period or prior to this period of rate rises. How does that make you think about the benefit or the opportunities with fixed rates? What do you like about them? What do you not like about them for new clients?
Okay. Fixed rates, personally, I'm not a big fan of them, I have to say. The one thing that a fixed rate will give you is certainty as to what your repayments are going to be for a particular period of time. What it won't give you is the flexibility that you may need to make additional payments, sell your property if something happens, changes to your circumstances, etc. So,
can you just talk a little bit to the lack of flexibility with a fixed rate loan?
Yes, okay. Most fixed rate loans, you can't make additional payments, or if you can make additional payments, it's very, very limited as to how much you can do without paying a penalty. And from a fixed rate point of view, banks look at it as though they've invested or they have a contract with you for you to pay them X amount of % on their investment with you for a period of time. Now, if you want to break that contract and they are going to lose out, they will want to recoup what they're going to lose.
So you have some form of an exit penalty.
Exactly, that's right. And depending on whether rates are going up or down, that will depend on whether that works to your favour or not. If it works to the bank's favour, they'll gladly say, yep, we'll let you out of your fixed rate contract. They won't give you any recompense for doing that, but they'll say, on your merry way. But if it's going the other way and they're going to lose, they'll charge you. And those penalties can be quite substantial. I've had clients who locked in at 5%, and when they did lock in, that was a pretty good rate. Then we weren't to know it, but 2 years down the track, that 5% on a variable rate is probably 2%, and they're paying well and truly over the odds. But to get out of that, they're going to have to pay all the difference anyway. So they had to sit there and wait. There's two parts to the equation. As I said, it will give you certainty as far as your repayments go, so that's great. You lose your flexibility. And the other side of it too is that I've got some clients at the moment that are locked in at 1.98 for a couple of years, which is great. They're in for a hell of a shock in 12 months' time when that comes off and they go to their variable rate, which could be 4 or 5.
We were talking about this the other day. We were talking about if you are on a fixed rate that's a good one like that sort of 2 region, that's great, but you've got to do some planning early. Like you've almost got to be putting aside that extra bit, doing some calculations to know, righto, when the day comes, the glory days are over, and it's going to double. Don't just sit there and float along and then let it hit you like a ton of bricks when it does come through, because there will be a significant difference in that monthly outlay. So might be just a bit of opinion, but in the last, because of the fact rates have been so low, a lot of people have also entered the property market in the last 5-6 years. They have a strong obsession with fixed rates because fixed rates were lower than variable rates, which, can correct me if I'm wrong here, but historically probably hasn't been the case too often.
No, not at all. And that came about because of the COVID pandemic, basically. The federal government put a heap of funds, if you like, to the way of the major banks and to keep things rolling along, and the banks in their wisdom decided to put the bulk of that into fixed rates, abnormally discounted rate, if you like. And so that's what led to those lower fixed rates, which are normally higher than a variable. If you look at fixed rates today, for example, now that that program is finished, fixed rates now are generally higher than a variable rate.
And traditionally that's always been the case, hasn't it? And I think a lot of people would not be aware of that because they've never seen it. And, a lot of people, like I said, they've been dialed into these fixed rates, and when they get to the end of that, they're going to wonder what's next.
I've seen studies taken over a period of 15 to 20 years, fixed rate versus variable, and the outcome of that was that if you'd stuck with variable for that period of time, given no other circumstances changing, you'd be in front of you on the variable.
It's a little bit like the time in the market, calculation over time, accepting the variability of time rather than try to jump in and out, trying to pick the high and the low. I mean, it's quite a close analogy that, getting a fixed rate's more, getting it right is probably more good luck than good management.
True, exactly that.
Yeah, I think, and how you go about it, I know for a lot of the clients that have, sent you away, they've gone that hybrid approach of over the last few years where they've locked in, let's just say 50-50. So, that's always an option for people. They want some certainty, but they want to also be able to pay a bit extra down. You can sort of have a bit of both sides of there as well. Moving forward, it might change, but that's what we've seen. Oh,
you can. And look, in fairness, over those last couple of years, those fixed rates were fantastic.
They couldn't really get any lower, could they? So I suppose it was,
We're nearing in on an hour, so we might wrap up with maybe a little snapshot for you, Will, on how people can find you. So if people are looking to either refinance or they're looking to buy property, where can they find you? And maybe before we get to that, is there any type of lending that you don't do? So that's residential, commercial. What are the types of lending you do and the types that you don't, and then where can people find you on the interwebs?
All right. So we concentrate predominantly on residential mortgages. We do commercial. We also do vehicle finance. Personal loans is another one that we do. Not a lot of people know that. And we have access to good rates for personal loans, far better than what the banks will offer. So there's those sorts of things. Residential mortgages, rural properties we can do. Commercial stuff we don't do a lot of, but we do have access to funds for commercial property if people are that way inclined. The bulk of what we do is for purchases, refinancing residential stuff to release equity for various purposes, be it investing with people like yourselves or buying another investment property. We do a lot of that sort of stuff as well. Really across the board, I come out of the motor industry, be that good or a bad thing, I don't know, but we used to have a saying there that there's a bum for every seat. And I would like to think, regardless of what your inquiry is, if it's to do with finance and financing, we should be able to look after you.
What about self-managed super fund lending, Will?
Yes. Again, we do SMSF funding. It's interesting how players, lenders I'm talking about, come in and out of that field as time goes by. So for a while, everybody was in there. Then a lot of them dropped out. And so now a few more are coming back in. So there's a bit more of a competitive edge to what we can do for self-managed super fund lending. We also do we have some particular niches. There's a market, if you like, for NDIS properties, and which seem to give very, very good returns. Not a lot of the banks will fund those sort of properties, but we do have, again, access to funders that specifically look after that particular area. So
is that similar to defence housing?
Along similar lines, it is, yes, but it's building specific properties to a certain level of spec for people who are in the IS sphere, and it's providing a great service, I believe, people to be able to live in the community rather than being institutionalised and live in a home of their own, if you like. So that's relatively new, but it is something I think we'll see more of as we go forward.
One other one, reverse mortgages.
Yes, yep. Again, as our population ages, and you guys would see this probably more often than what I do. You know, from my generation, we were taught at school, pay off your house and you'll, get a good job and pay off your house and that'll be fine. Well, when you want to retire and you need some funds to live on, you can't sell off a bedroom or something like that to turn into some cash to keep you going. So there are lots and lots of people, I believe, of my generation that have got very good equity in their homes, but that's not going to feed them in retirement. And so they need to generate some cash or cash flow from somewhere, and a reverse mortgage is one good way of doing that.
For most people, it's their biggest asset by far.
Yeah.
So they need access to it. I think we've seen a bit more of that coming online over the last period of time. So sort of better throw that in there.
No, it's a good one. I'm glad you mentioned it. And it's, again, there are several players in that field. We've partnered up with one that we've had some experience with now over a number of years, and we're more than happy to recommend.
Perfect.
Now, where can we find you,
You
Will?
can find us on the web if you go to all the W's, Achieve Home Loans with an S, ACHIEVE, homeloans with an S.com.au, and you'll find a fair amount of information on there. There are obviously forms there where you can contact us. You can ring the office at any time, 52297866, and one of our friendly staff will be there to answer your queries. Initial consultations, we'll talk to you. We don't charge you anything for that. We're happy to talk and get an idea of where you're coming from. I relate that to people who don't go to the doctor and say, Doc, I'm sick, I need some pills. The doc wants to know and talk to you about your situation and know your background and things so that he can recommend something appropriate, and we're no different.
I know you're old school, Will, and you probably prefer to catch up with people in person, but if someone wanted to catch up with you via Zoom or Skype or something like that, are you able to do that as well?
I've been dragged kicking and screaming into the 22nd century in the last little while, but yeah, so certainly I am old school, and I believe that looking someone in the eye and talking to them across the kitchen table or something like that is the best way to go. But I realise in today's modern world, Zoom, Skype, that sort of stuff isn't a problem either. And we do after-hours appointments. A lot of mums and dads working during the day can't see us until after hours. Happy to cope with that sort of stuff as well.
Beautiful. Any closing comments from you, Ben?
No, I think, obviously, I see the value in brokers and using someone like yourself. I think more and more people now understand that, and they sort of have that lack of trust of just walking into, you're with the Commonwealth Bank your whole life. Mm-hmm. Just because you walk in there off the street and been there 25 years doesn't mean they're going to look after you. So you need to use brokers to your advantage, and they'll help you and guide you, explain things in much better terms, and get you the best outcome. So I'm always bang on about using a broker, and obviously we've had a lot to do with each other over the years, so trust you guys to keep doing that. It's
interesting. I read a stat just the other day that over 70% of home loans now are introduced through the broker network. And you touched on there about loyalty with your bank. I can assure you they have none to you. And it's an indictment, frankly, on the banks themselves that they will more often than not offer a better deal to a stranger than they will to their existing clientele. And we're onto them all the time about looking after their clients. And in fact, we go into bat for our clients with the banks they're with to get better rates as we go forward. So
the other thing that you said, the trust that we have in Will and the work that he does with our clients, is the importance of the relationship between a client's financial advisor and their broker and maybe their solicitor and accountant. I know we speak about this a lot, that there's sort of 3 or 4 core professionals that, if working together, can get a great outcome for clients. And that's why I think we don't profess to be the experts of everything lending. That's why it's important that we defer to people like yourself, Will, but work closely in conjunction with you. And also the other way, making sure that if you've got any clients that we can help provide direction or support with, that we're there to do that as well. It's super important to have those mutual relationships.
Well, it certainly is. And it brings to mind a very recent application that we had, and it was quite a complex situation. But because we could have access to yourselves as the person's financial planner, to their accountant for their financials, and ourselves, and between the lot of us, we were able to put together a deal that, to be frank with you, nobody else would have been able to do for them.
Yep,
Definitely.
All right, Will. Well, thanks again, mate. Really appreciate the time today and also the last nearly decade that we've worked together. Thanks for your expertise, your insight into what's going on in the property market, in the lending space, and we look forward to having you back on in a future episode. Thanks again.
Thanks for your time. Good to see you.
Thanks, mate.
We hope you enjoyed today's episode. If you're keen to understand more about how financial advice could benefit you, follow us on Instagram, Facebook, and Twitter at Burke Britton FP, or Google Burke Britton Financial Partners. Check out our client reviews, testimonials, and make a time to meet one of our certified financial planners by clicking Book Now on our website. Thanks for listening.
Any information contained in this podcast is of a general nature only. No account was taken as to the objectives, financial situation, or needs of any particular person. Therefore, before making any decision, listeners should consider the appropriateness of any information with regard to their particular objective, financial situation, needs, and seek independent advice from a licensed professional specific to their circumstances.
All right, hit it.
That translates to don't be a moron and act on what some random person says on a podcast. Take personal responsibility. Do your homework. Ask questions and speak to an actual human that knows what they're talking about before you do anything. PB Financial Solutions Proprietary Limited, trading as Burke Britton Financial Partners, are authorised representatives of AMP Financial Planning Limited, AFS, licence number 232706.